Welcome back to the deep dive. Today, we are looking at a giant, and I mean a literal giant of American industry. We are talking about Big Red,
Verizon.
Verizon, the company that for a very long time was just synonymous with being the network.
Can you hear me now? That
Yeah.
was their whole identity.
Exactly. And, if you think you know Verizon because you pay them a monthly bill for your phone, or maybe you've got Fios at home, the sources we've been digging into paint a drastically different picture.
It's now the same company.
Yeah.
Not even close.
We're not looking at the phone company of 2015. We're looking at a company right in the middle of this massive high-stakes identity crisis.
It's a fascinating moment to be looking at them, really. For context, it is Monday, January 19th, 2026.
Right.
And that date is really important because tomorrow, January 20th, is the scheduled closing of Verizon's $20 billion acquisition of Frontier Communications.
Which is it's huge.
It is massive. But what makes it so interesting isn't just a merger. It's the man at the helm. You've got Dan Schulman, the former CEO of PayPal.
An outsider.
A complete outsider who is essentially betting the house on things that sound more like science fiction than, telecommunications.
Right. We're talking about artificial general intelligence, AGI.
Quantum computing.
And this one blew my mind. Literally selling the physical space inside their old, dusty telephone exchanges to Amazon.
Yeah, that's the part that really clicks and you go, oh, I see what's happening here.
Exactly. So the mission for today is to really unpack this full reboot strategy. Is this just a desperate pivot for a company that lost its #1 spot? Or is this some kind of genius maneuver to become the physical backbone of the AI economy?
That is the multi-billion-dollar question, isn't it?
It really is. So let's start with the context. We have to set the stage. Before we get to the robots and the quantum computers, where has Verizon been? Because our sources keep referring to this previous period as the lost decade. That sounds harsh.
It is harsh, but, the numbers really back it up. If you look at the era under the previous CEO, Hans Vestberg, it was defined by what insiders called the network engineering philosophy.
Okay.
And the core belief was incredibly simple. Build the absolute best network, the most technically superior network, and customers will pay a premium for it.
Build it and they will come. A classic strategy.
Precisely. And for a very long time, that worked.
Right.
I mean, let's be clear. Verizon had the best coverage. They had the reliability.
Yeah.
People paid more because they knew it would just work.
But something changed.
Something big changed.
Yeah.
The reality of the last, say, 8 years has been brutal for them. Competitors, and we're talking specifically T-Mobile, but also AT&T, they spent billions, just a fire hose of cash to catch up on 5G.
And they did.
They did. The gap in network quality, the very thing Verizon hung its entire brand on, it just narrowed significantly.
Yeah.
To the average person, the difference between great and good enough,
It's barely noticeable on your phone.
it's negligible.
Yeah.
And when the product looks the same to the customer, but one costs a lot more,
You start to question why you're paying that premium.
exactly, you start bleeding customers. And the metrics in our sources are, frankly, startling. Over an 8-year period leading up to this reboot, Verizon lost 30% of its market share.
30%! That's not a slow leak, that's a hemorrhage.
It's a catastrophe for a company that size. They fell from being the #1 telco in market cap in bond ratings all the way to number 3.
Number 3. That is a long, long fall for Big Red.
It is. And it wasn't just, a bad quarter or a bad year. It was structural. Mark Bertolini, the chairman of the board, was very candid about this in our sources. He said, and this is a quote, "Losing 30% share over the last 8 years is an issue."
That's some serious board speak for we are in crisis mode.
That is the 5-alarm fire bell ringing in the boardroom. And that is what triggered the leadership change. That's what brought Dan Schulman in.
Okay, so before we get to Schulman and the fix, let's quickly talk about the money engine. How does this company, even in its weakened state, actually make cash right now?
Yeah, it's really important to visualize the scale here, because even with all the struggles, this is a massive ship. It is not easy to turn.
You're still a behemoth.
Absolutely. You have the consumer group, which is roughly 76% of their revenue.
Okay, that's the biggest piece.
By far. And that's what you'd expect. It's your wireless plans, Verizon, TracFone, Visible Your Fios internet, and this growing business, fixed wireless access.
Right, the 5G home internet boxes.
Exactly. Those little boxes that grab 5G from the air for your home internet. And that's not a small business anymore. It hit an annualized revenue of $3 billion by late last year.
Wow, okay.
Then you have the business group.
Nice.
That's about 22% of revenue. And that's your big enterprise clients, small business, public sector, government contracts.
Got it.
But the key split to understand, and this is really crucial for the whole reboot story, is the difference between service revenue and equipment revenue.
Okay, break that down for us. What's the difference?
So service revenue is your monthly bill. It's predictable, it's subscription-based, it's high margin, and that's about 83% of the money.
That's the good stuff.
That's the golden goose. Equipment revenue, on the other hand, is them selling you the actual iPhone or the Samsung Galaxy. That's lower margin, only about 17% of revenue.
So they're not making much money on the phone itself.
Right. And the problem Verizon faced was that to keep that high margin service revenue, they were having to basically give away the phones or play all these pricing games that, frankly, just annoyed people and eroded trust.
Which brings us perfectly to the new sheriff in town, Dan Schulman. He comes from PayPal. He's a tech guy, a payment guy, not a telecom lifer. And he comes in with this mandate for a full reboot.
And he did not waste any time changing the philosophy. If the old way was engineering first, Schulman's philosophy is customer-centric.
Now, that sounds like a corporate buzzword, right? I mean, every company says they're customer-centric. It's on every mission statement in the world.
Of course. It's easy to say. But Schulman defined it by what he stopped doing. He explicitly and very publicly rejected the old tactic of just raising prices on the existing customer base to squeeze out more revenue.
The easy lever to pull.
The easiest one.
Yeah.
He has this line that came up in the earnings calls again and again. Pricing is the last refuge of the marketing desperate.
I love that quote, the last refuge of the marketing desperate. It's basically saying, if the only good idea you have left is to charge your loyal customers more, you've already lost.
You've run out of ideas.
Mm-hmm.
Exactly. So he's shifting the entire metric of success. It's no longer about just grabbing new customers. The new goal is growth through retention.
Keep the ones you have.
His stated goal is to have the lowest churn rate in the industry. The logic is simple. It costs a fortune in marketing and promotions to acquire a new customer. If you can just stop the ones you have from leaving, your profitability skyrockets.
Makes perfect sense. But he's not just talking about, being nicer to customers on the phone. He's talking about speed. The sources mention this 10x mindset.
Yeah.
What does that mean in practice?
This is where his Silicon Valley, his tech CEO background, really shows up.
Mm-hmm.
Schulman's theory is that the world, and specifically the technological world, is changing exponentially, not linearly.
Right.
And he has this warning that he gives his team.
If the pace of change external to a company is greater than the pace of change internal, you're in big trouble.
You're already dead. You just don't know it yet. You're roadkill.
You're roadkill. Right. So he's telling a company that is in its DNA, over 100 years old, that incremental 10% improvements are not enough anymore.
Not going to cut it.
Not going to cut it. He wants 10x the speed or 110th the cost. A total reinvention. And that brings us to the painful part of the reboot. The scrappy restructuring.
Yeah, we have to talk about this,
Yeah,
because scrappy in a corporate context usually means one thing.
Doing more with less people.
It does. To fund this better customer experience, to fund things like price locks and better value, Schulman initiated a massive workforce reduction, a painful one.
How big are we talking?
We're talking about cutting 13,000 to 15,000 jobs.
Wow.
That is roughly 20% of their non-union management workforce.
20%. That is a huge slice of the corporate structure. That's not just trimming the fat, that's cutting into the bone.
It's ruthless. But Schulman's argument is that it's necessary. You have to strip out the structural costs that built up over decades of being, a comfortable monopoly.
So the layoffs are one part. What else?
He's also franchising about 200 corporate-owned stores.
Okay, so what does that do?
It shifts the cost off Verizon's books. Instead of Verizon paying the rent, the utilities, the salaries for that store, a franchise owner does.
Yeah.
It's an asset-light model. The goal of all this is to free up capital, to free up cash, to invest in things that actually keep customers happy.
Like better apps, better service, stable prices.
Without completely destroying the profit margins that Wall Street demands.
Mm-hmm.
It's a very fine line to walk.
So he's slimming down the organization to make it run faster, but at the same time, he's bulking up the actual assets. And that leads us to the big event. The one happening tomorrow, the Frontier acquisition, $20 billion.
This is the turning point. This is the centerpiece of the whole strategy. Tomorrow, January 20th, 2026, Verizon officially closes the deal to buy Frontier Communications.
And to understand why they're spending $20 billion on a company that, a lot of people think of as just old landlines, you have to understand one word, and you mentioned it, Convergence.
Convergence. It's the magic word in telecom right now.
Okay, let's really unpack this, because usually when I hear a word like convergence, I just think it's marketing speak. But the numbers here, they seem pretty compelling.
The numbers are undeniable. It's not just marketing. Convergence simply means selling both fiber home internet and mobile phone service to the same household. A bundle.
Like the old triple play, but, for the modern era.
Exactly. But here's why it matters so much. The data, and this is from their own internal studies, shows that converged customers, people who buy both home internet and their phone from Verizon, they churn at rates that are 40% to 50% lower than people who just have a mobile phone.
Wait, say that again? 40 to 50%.
40 to 50% lower.
So if I have my house and my phone with you, I am literally half as likely to quit.
Yes, it is an incredible number. It creates this massive sticky moat around the customer. Once you bundle the house and the phone, the hassle of switching both services just becomes too high for most people.
You just stop shopping around.
You stop looking at competitors' ads. You're locked in. And Frontier is the key to unlocking this because Verizon was, in their words, under-indexed in the territories that Frontier covers.
Under-index, meaning they just didn't have enough mobile customers in those areas.
Right. It was a weird gap in their map.
Yep.
In the very areas where Frontier has all this beautiful fiber in the ground, Verizon's market share for mobile was lower than its national average.
So a perfect fit.
It's a hand-in-glove fit.
Yeah.
So the plan for day one, which is tomorrow, is a massive cross-selling campaign. They take the millions of Frontier broadband customers and say, hey, you have our fiber. Now switch your mobile to Verizon and get a huge discount.
And the reverse.
And the reverse. They go to the existing Verizon mobile customers in those areas and say, hey, we now own the best fiber network in your neighborhood. Let's bundle it.
It's a land grab. It's a way to rapidly grow both businesses at once.
It is. It adds nearly 30 million fiber passings to Verizon's footprint overnight. It's a massive injection of growth potential.
And what about the integration? Because big mergers, especially in telco, are famous for being, technological nightmare.
They usually are. A nightmare of incompatible billing systems, different network gear. But the sources point out something really important here, and it's a bit of a historical irony.
Oh.
A lot of Frontier's network is actually ex-Verizon assets.
No way.
Yes. Stuff that Verizon was forced to sell off or divested years and years ago to satisfy regulators.
Oh, that's right. I remember that now. They sold off all those rural lines, and now they're buying them back.
Exactly. So the tech stack is actually quite harmonized already. It's not like trying to merge two alien civilizations. It's more like, welcoming a prodigal son back home. It dramatically lowers the execution risk of the whole deal.
That's a huge point. So that's the consumer side of the reboot. Use Frontier to create this sticky, converged customer base that never leaves. But there's another side to this, the one I found even more fascinating. And this is where we get into the big tech territory. Part 4, AI Connect.
This is the real aha moment for a lot of investors, I think. For years, people looked at Verizon's legacy assets, those thousands of central offices, the old telephone exchanges in every town. They look at them as liabilities.
Right. Old, dusty real estate full of copper wire that nobody uses anymore.
The buildings with no windows, they were seen as a drag on the balance sheet. But Schulman and his team looked at those buildings and realized something that was hiding in plain sight. These buildings have massive power hookups. They have industrial-grade cooling systems. They are incredibly secure. And most importantly, they are physically located right in the heart of major population centers.
They are prime real estate, just not for people.
They're data centers waiting to happen. And that's the strategy. It's called AI Connect. Verizon is pivoting from just being a consumer telco to being the physical infrastructure partner for the hyperscalers.
So AWS, Google, Meta.
The giants. So instead of trying to fight big tech, they are selling them the picks and shovels for the AI gold rush.
And is it working?
Well, the sources mentioned a sales funnel of over $1 billion already generated from this initiative.
$1 billion just from renting out space in old buildings.
And selling them the high-speed fiber that connects those buildings. The crown jewel of this is the deal with Amazon Web Services, AWS, that was announced in late 2025. Verizon is literally building new long-haul fiber routes, specifically to connect AWS data centers to each other and to the world.
But why does Amazon need Verizon to do that? I mean, can't they just lay their own fiber? They're Amazon.
They can, and they do. But generative AI is changing the physics of the internet. It's not just about bandwidth anymore. It requires massive bandwidth and, crucially, incredibly low latency. And this brings us to what they call the edge thesis.
Okay, the edge. We hear this term all the time. Can you explain it like I'm 5? Or, maybe like I'm a reasonably smart person who doesn't work in IT.
It's a great question. Think of it this way. Right now, most of the giant AI models, like the big LLMs we all talk to, they're trained in these massive centralized data centers.
Okay.
Think of those as giant warehouses out in the middle of nowhere, where land and power are super cheap, like in Oregon or Virginia.
Central warehouse. Got it.
But when you actually use the AI, when you ask it a question on your phone and it gives you an answer, that process is called inference. And Schulman's big bet is that inference is going to move from the central warehouse to the edge.
Meaning closer to the user.
Exactly. It needs to be physically closer to you to be fast. You can't send every single request halfway across the country and back if you want a self-driving car to react in real time, or a robot surgeon to be precise.
So you don't need the central warehouse anymore. You need a local fulfillment center.
That is the perfect analogy. You need a local fulfillment center in every major city.
Yeah.
And who just happens to own thousands of secure, powered, cooled buildings that are perfectly positioned to be those local fulfillment centers in every major city in America?
Verizon, because of those old telephone exchanges.
Bingo. They own the metro fiber networks that connect everything. They own the buildings. So they're going to Amazon and Google and saying, don't build new data centers in the city. It's expensive. Just put your AI servers in our central offices. We've got the power, we've got the cooling, and we're already right next to the customer.
That saves the hyperscalers a fortune.
A fortune. It saves on real estate, and it saves on transport. Costs moving huge amounts of data around is incredibly expensive, and most importantly, it cuts latency down to almost nothing.
That is absolutely genius. It turns a legacy anchor that was dragging them down into a rocket booster for the future.
It's monetizing the physical layer of the AI economy. It's a very, very smart pivot.
And it seems like Schulman is completely obsessed with this future tech. The sources detail his vision of what he calls the 3 waves. He believes there is this tsunami of technology coming, and Verizon has to be riding it, not get crushed by it.
Yeah, this is from a very interesting interview he gave. He outlines these 3 massive waves that he believes are all crashing down on us simultaneously.
Okay, what are they?
Wave 1 is AGI, artificial general intelligence.
And his timeline on this was aggressive.
Very aggressive.
Yeah.
He predicted AGI within 2 to 4 years.
2 to 4 years from now.
Yes. And he defined it very clearly as machines doing everything better than humans.
That is. I mean, most experts are still thinking a decade, maybe more. He's saying it's right around the corner.
He is. And he says his private conversations with the leaders in the AI community back that up. So that's wave 1. Wave 2 is quantum computing.
Right.
He sees that hitting around 2030. And he's not talking about lab experiments. He's talking about data centers with 1 million fault-resistant qubits.
Which sounds like something straight out of Star Trek.
It does. But his point is practical. He says AI is a compute hog.
Yeah.
It's insatiable. Conventional computers, even the best ones we have today, won't be able to keep up with the processing demands of true AGI.
So you need quantum to run the AI of the future.
You need a fundamentally new type of computation. And the third wave?
What's wave 3?
Humanoid robotics. Within 5 to 7 years.
Actual robots walking around doing jobs in factories and warehouses.
Stronger than humans, smarter than humans, ever get tired, never take a break. And this is where he brings it all back to Verizon.
Right, because Verizon isn't building the robots.
No. But those robots, they need a nervous system. They need to communicate with the cloud and with each other instantly, with 0 lag. That requires a private 5G network with mobile edge compute MEC.
So if the robot's connection lags for even a millisecond, it drops the expensive box it's carrying. Verizon prevents the lag.
You got it. So Schulman's grand vision is that Verizon builds the low-latency nervous system that allows the entire robot economy to function.
It's a grand vision. It's huge. But he's also using this stuff internally right now, isn't he? It's not just for selling to future robot overlords.
No, and this is a key point that connects back to the scrappy cost-cutting we talked about. They are using what they call agentic AI internally today.
Okay.
They have already deployed Gen AI to 44,000 of their customer care agents.
44,000 agents are using this.
And it's used to reduce what they call cognitive load. The AI listens to the customer call in real time. It summarizes the conversation. It predicts what the customer is going to need next. And it even routes the call based on sentiment.
So if the customer's angry,
They get routed to a specialized de-escalation agent. If they sound like they want to buy something, they go to sales. It makes the human agents far more efficient, which of course allows Verizon to run the same call center with fewer humans.
which connects directly back to the layoffs. It's all one interconnected strategy. The tech enables the restructuring.
Precisely. The cost savings from the AI pay for the investment in the AI. It's a virtuous cycle if they can get it right.
Okay, let's take a breath and look at the checkbook. Because dreams of quantum computers and robot nervous systems are expensive, and Verizon has a very, very large credit card bill. Let's talk about the financial health.
This is the reality check. This is the part that makes some investors very nervous. The balance sheet is heavy.
That's a polite way of putting it.
Verizon is carrying a massive debt load. We are talking about $146.8 billion in unsecured debt. And remember, the Frontier deal adds another $11 billion in assumed debt to that pile.
That is a staggering amount of debt, especially now that interest rates aren't zero anymore.
It is. It's the single biggest risk factor for the company. High interest rates hurt their ability to service that debt. However, there's a nuance here.
Okay.
A lot of their total reported debt is actually self-retiring ABS, asset-backed securities. It's tied to the device payment plans. So as people pay off their iPhones every month, that portion of the debt just automatically disappears. It's not as scary as the headline number looks.
Still, it's a big number.
It is,
Right.
but you have to balance it against the cash cow nature of the business. This is not a startup burning cash. In the first 9 months of 2025 alone, they generated $15.8 billion in free cash flow.
So that's money in the bank after paying all the bills, all the capital expenditures.
All of it. So they are a debt-heavy company, but they are also a cash-printing machine. And that cash is what funds the all-important dividend.
Which is a big reason people own the stock.
It's huge. The yield is around 7%. Management calls their commitment to that dividend ironclad. It is protected by a payout ratio of about 58% of that free cash flow. So it's covered.
So for the listener who owns Verizon stock for the income, the message from management is don't panic.
The message is that the dividend is safe if that cash flow stays strong. But the real story for investors, the thing that makes this so interesting, is what some analysts are calling the asymmetric bet. It's about the stock price itself.
Right, because for years, it's been trading like a boring, no-growth utility.
Exactly. It's trading at a price-to-earnings ratio, a PE, of about 8.5x forward earnings. That is very, very low. It's valued like a company that is slowly melting away.
But the bull case is different.
The bull case, the optimistic view, is that if Schulman can just do two things, stabilize the subscriber base so it stops bleeding and successfully integrate Frontier, then the market will have to reevaluate the company. The stock could re-rate to a higher multiple.
So instead of 8.5x earnings, maybe.
Maybe a more normal 12x, which is still not expensive.
And if that happens, the valuation goes way up.
A simple re-rating to 12x would drive the stock price to somewhere between $55 and $60. That's about 40% higher than where it is now, on top of the 7% dividend. And here is the real kicker.
Okay.
Dan Schulman's paycheck depends on it.
Show me the incentives, and I'll show you the outcome.
His compensation package is heavily backloaded with equity. He only gets his maximum payout, the big money, the reason he took the job, if the stock price hits a range between $55 and $75.
And it's trading around $40 now, so he needs to nearly double the stock price to get his full payout.
That is a very powerful incentive to make this full reboot actually work. His financial interests are perfectly aligned with the shareholders in a big way.
But there are still major risks. We mentioned the debt. What else could go wrong here?
Execution risk is huge. The cultural shift is the biggest one. Trying to make a 100-year-old engineering company act like a scrappy, fast-moving startup is, it's like trying to make an elephant dance. It's possible, but it is incredibly difficult.
And the competition isn't just sitting there watching this happen.
Not at all. T-Mobile is still incredibly aggressive. AT&T has become much more disciplined. And if the economy takes a nosedive and people start having trouble paying their phone bills, that massive debt load suddenly becomes a much bigger problem.
So bringing it all together as we wrap up here, we are looking at a company that is trying to do two almost contradictory things at the same time.
That is the perfect synthesis. That's the tension at the heart of the story. On one hand, they are trying to be the boring, reliable, predictable utility that pays a 7% dividend to your grandmother's retirement fund.
Right. Safe and steady.
And at the exact same time, they were trying to be a scrappy, high-growth, innovative tech platform that is powering the AI revolution and building the infrastructure for quantum computing.
It's a very delicate balancing act. And the big question is, can an organization this old, this large, actually move 10x faster, as Schulman demands? Or is that just, fancy corporate speak to justify firing 15,000 people and cutting costs?
That is the question the market is waiting to see answered. And the Frontier integration, which starts tomorrow, will be the first big test. If they can execute on that, if they can actually lower the churn and cross-sell effectively, then the reboot is real. If they stumble, it could just look like more rearranging the deck chairs on the Titanic.
Here's the final thought for you to chew on, and this is the one that kind of kept me up last night after reading all this. If Schulman is even close to right about AGI arriving in 2 to 4 years, does the monthly churn of human phone subscribers even matter in the long run?
That is a very provocative thought.
Seriously. I mean, if the future is billions of robots and trillions of AI agents all talking to each other all the time, the real revenue might not be you or me paying $50 a month for our phone plan.
The real revenue is the machines paying for the bandwidth to think.
Exactly. In that world, the number of human subscribers is almost irrelevant. The total volume of data flowing through the pipes is the only metric that matters. And in that world, the company that owns the pipes and the edge nodes, those local fulfillment centers, that company wins.
It's a fascinating mind-bending pivot. From selling talk time to humans to selling thought time to machines.
And we are going to start finding out if it works sooner than we think.
The first test case is tomorrow.
Absolutely. Well, keep an eye on the news tomorrow for that Frontier closing. It's the official start of a new and uncertain era for Big Red. Thanks for listening to The Deep Dive. We'll see you next time.